to another edition of the Chicks on the Right podcast, where we bring in our friend Zach Abraham, who is the Chief Investment Officer at Bulwark Capital Management, to help us break down what's happening in the financial world, the economic world that we are in. And earlier this week, Zach, we played a clip on our regular live stream of Charles Payne, which was very depressing because it was basically him just saying, things are looking really shitty out there, you guys. Mm-hmm. It's bad. And it's just totally counter narrative to everything that Democrats are saying right now. They're like, Bidenomics, yay, everything's rosy. Yeah. What is going on? What is the real deal?
So I think that we got a lot of cross currents going on, and I think it's really confusing. And I think one of the biggest things that's confusing people is it's been almost 40 years since our last bout with inflation, right? And people see these growth numbers and they're like, wow, the economy is cranking. The reason that's the thought, if I see a 5.5% GDP for a quarter, the reason that looks really good is we have what we call nominal growth versus real growth, right? And it really makes sense. If the economy is growing at 5.5%, but you have 6% inflation, you're not growing, right? You're shrinking, right? Well, for so long, 5% growth was with a 2 to 2.5% inflation backdrop. Okay. So now you've got them posting 5.5. The Atlanta Fed, which has been pretty accurate, in the last 30 days have dropped their GDP estimate from 5.9 to 4.9. That's a big move south. Okay. We're showing inflation ranging between 4 to 5. Okay. So what does that tell you? It tells you there's no growth. Okay, now in a 0% interest rate environment, that's not as much of a problem because the tab isn't running, right? Everybody can refinance at record low rates. Money's free essentially, especially for banks to borrow and shadow banks and all these different things. But you're looking at corporate debt. We saw a couple corporate debt refinancings happen, just quite a few. There's going to be a deluge of them next year. That's another thing nobody's working into their earnings forecast. If the average S&P 500 company has to take a couple $1 billion pile of debt and refinance it at 5 to 6 as opposed to 2.5 to 3, okay, that's getting sucked right out of earnings, right? So everybody is trading, in my opinion, based off of the last 15 years, meaning it's like 0% interest rates, but they're not paying attention to the pernicious nature of interest rates and how they continue to chew away at things as time goes on, right? Like if you think about the last 15 years, we had several economic scares, right? But you're at 0% interest rates. So the minute something bad happened, the Fed would just start buying US government treasuries or mortgage-backed securities again. Liquidity starts getting pumped into the system and rising tide lifts all boats, right? Well, the opposite is happening now, and everybody is behaving as if it's the same. So what we're seeing right now is a rapid deterioration in consumer spending. Now, when I say rapid, I mean coming from a lofty level down to close to flat, okay, 0. Now, everybody goes, well, it's not regressing. And I'm like, well, remember, consumer spending is inflation. It's reflecting inflation. So if consumer spending stays flat, but inflation rises 5%, you're going to look like, now there's certain metrics that pull out inflation, but bottom line is if consumer spending is flat and inflation's running at 5%, you are going backwards, and you're going backwards in a meaningful way, right? Here's the other cue. If it was as good as everybody's saying, why so many earnings misses and downward revisions? Why did U.S. airlines come out and guide for lower and lower their own profitability targets? Why did Delta come out and do the exact same thing? What are we constantly hearing? The consumer's strong, the service industry is strong, right? Traditionally, we see things like flight, travel, and the services sector kind of be the last to roll over. Well, you're listening to restaurants coming out and saying they're missing, that foot traffic's down. Airlines are coming saying that it's dropping, right? And here's the issue. The issue is you have a market that is priced as if rates are at 0, okay? And the Fed is still buying treasuries and stimmies are still in everybody's pockets, right? Stimulus. It's not the case. So we're looking at an economy where you're going, okay, you guys are pricing this market as if consumer spending is just going to keep rising. It's not. That's craziness, right? You look at what's happened to interest rates and taking away the stimulus. And then also, guys, think about how many durable goods. So durable goods are something that we buy in the economy that lasts for a refrigerator, a washing machine, right? Stuff like that. Okay, well, Do you think people are going to continue to buy those things at the paces they have over the last 2.5 to 3 years? Of course not. You don't need three laundry or washing machines, right? You don't need three backyard remodels. So part of it, and this gets into the definition of economics when we talk about stimulus. Okay, stimulus doesn't create new economic activity. What it does is it sucks future economic activity into the present, right? Meaning, if you pass a new stimulus deal or a new tax break to buy a new car, I'm going to buy a new car this year, but I'm not going to keep buying new cars every year.
Exactly.
Right? So at the same time you're watching this commercial real estate, and look, the commercial office space is getting smoked no matter what anybody says. Okay. We'll continue to say the same in residential housing. I'm listening to these people going, residential housing isn't down. And I'm like, dude, quit looking at the official numbers. Volumes of house sales are down 50%. Okay. What does that mean? The only houses that are being sold are people that can afford to sell them, meaning they're not worried about getting into another high interest rate loan, right? And it's people who can pay cash. What did we just describe? The wealthy. Okay, so the wealthy people, or the people who aren't constrained fiscally, those are the sales you're seeing. So when you start looking at what prices these things need to be priced at in order to actually sell, it's significantly lower. And we can see that in markets like Houston, or we can see that in markets several in Texas. We can see it in Phoenix. We can see it in the Seattle area. You can see it in the Bay Area. And everybody's like, oh, housing's hanging in there. And you're like, housing's down 15 to 20%, depending on where you're at in the country, right? It's just not selling. And everybody's just got their fingers in their ears going, la, 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 tell me something good, right? The other part of it, and I'll kind of get into the anecdotal side of it, there's a saying in this industry that when you're managing money the correct way in a disciplined manner and you're not just chasing, at the height of every cycle, you should lose some of your clients. Okay, now we've lost very few, but so far this year, we've lost more clients. We've probably bled. This is a heck of a marketing ploy, right? Telling people that we've lost clients. But the reason we've lost clients is we're up a couple percent. We're positioned very securely. One of the reasons, guys, that we were positioned securely is last year when markets were down 20 to 35 and the average retirement portfolio was down 25 to 27, our average client was down 6.5 to 7, right? So our attitude was, hey, we're going to keep playing it safe. If the market wants to come back and catch us, so be it. This isn't the environment where we want to be really aggressive, right? Well, the number one reason you lose clients in this industry is the market's going up and you're not. And the clients don't have usually they don't have the ability to sit back and go, wait a second, when I factor in how I did last year and this year, I'm still ahead of the game, right? That's not the way they look at it. And so anecdotally, you see people, I was having a conversation with a client the other day and I said, do you understand the things I'm telling you economically? And he goes, yeah, absolutely. And he goes, Zach, but at the end of the day, those stocks are still going up. And I go, well, for now, right? For now they are, right? So
and he's going to expect you to know exactly when they're going to stop doing what they're doing.
Oh yeah, 100%. And that's why, in investing, it kind of reminds me of the Bible, right? There's a season for everything. There's a time to be aggressive. There's a time to be, when we can sit back and own these ridiculously cheap companies that are producing things like natural gas, oil, and copper, things that the world desperately needs and is in short supply of, they're paying us 6 to 8% dividends to own it. The companies have zero debt and they're trading at 2 to 3 times earnings, right? And then I can own a chunk of 2-year treasuries that have virtually zero risk, paying me a guaranteed 5%. If the worst thing that happens to our clients this year is they make 6 to 7%, I'm okay with that, right? Yeah. But what people need to understand is that if you're being cautious right now, you're not missing out on a run. Okay, what you're doing is sitting there going, I don't think it is wise to pay ever more expensive prices for companies whose fundamentals are deteriorating right underneath them, right? Mm-hmm. And it's not that we're predicting it. It's happening. You see earnings down, revenues down. You see, a company like Apple, whose growth is at the lowest point we've seen in 20 years, launching a new phone that's $200 more, that's the exact same as the last phone they put out, which I own, and it's not a very great phone, quite honestly. It's just, this cycle has run its course and people are used to, for 15 years, things have gone up. And the sad thing about it is, guys, is that usually the least experienced and this is what happens in every cycle. The most inexperienced people get the most aggressive at precisely the wrong time. Here's another anecdotal piece of information. Retail investors right now are positioned more aggressively than they have ever been in history. So if this is like other times in the past, when retail gets the most excited, think of 1999 and 2000, that's the time you should be running from the hills, because those are the people that are not looking at the fundamentals. Those are the people that are trying to bid Tesla up as Tesla cuts the price of its cars by 20%, therefore erasing its margin and its profit. So, what we do, and we talked about this a little off air, what we're doing right now, and our attitude is really simple. We think that we live in crazy times. Okay. We think that guarding against the big downside move is the biggest threat here. And if we're wrong, you guys, one of the reasons we do it, honestly, is just for moral clarity and the ability to sleep at night. If our clients leave us because we made them 5 to 7% when the market's up 15 to 20, I can sleep at night, right? I don't want that to be the case. I'm really competitive. We've beaten the market the last 2 to 3 years in a row. I love doing that. At the end of the day, our job is to finance the rest of their lives, not to make the most in an insane market we can make in a 12-month period of time,
Yeah. It's a good philosophy. It's a really good philosophy to live by when it comes to this. Especially when, I think a lot of people that are leaving, they probably look over their shoulder and are like, well, dang, maybe I should have stayed.
Well, we already had a couple of those this year. We had a couple of those this year that left for whatever reasons over the last 2 years and got destroyed last year. And it's it's not a fun conversation to have. They came back with 20% less money, but through that experience, they become better clients because they understand, sometimes we will protect against risks that don't happen. That's just the name of the game. But if the worst case scenario is we make a little less, we can live with that. This isn't about, we're not at a craps table. We're not at a roulette table, right? We're trying to finance the rest of your life. And what's crazy is we live in an environment right now where everybody just thinks, oh, buy it, it's going up. Well, it's going up because a bunch of people that aren't informed are bidding up the price irrespective of the underlying fundamentals. And that's a losing game. It always has been. And, it will be this time.
Yep.
Well, the way that we talk about you to our audience is that, we talk about the fact that you actively manage risk and that you are helping people who are close to, nearing, or in retirement avoid losing big giant chunks of money. So what can people expect when they reach out to you? Like, what's your process? How can we tell them that you're going to best help them?
Yeah, well, so we do things very differently than everybody else. So first of all, when we sit down, I'll give a couple people if you ever interview somebody like me or somebody that works at another financial firm, and when you meet with them in the first meeting and they show up with investment suggestions, run. Okay, because they don't know you and they don't know what you're after. And if they already came with something to sell you or a preconceived idea of what you should have, it just means that they have a system and they're plugging you into it, right? What we do is we sit down and look at somebody's entire life and sit there and go, okay, what does Social Security look like? When do you think you're going to retire? How much do you owe on your house? Do you own any other rental properties? All of those things need to be considered before we can make a portfolio recommendation, right? We'll have people that come in that are virtually the same age that have the exact same amount of net worth, and they'll be invested completely different based on what the rest of their life looks like, right? And so it really comes, first and foremost, we need to assess what are your goals for retirement, right? What kind of income do we need to generate to complete those goals or to accomplish those goals? And then how do we sit back and how do we accomplish those goals taking as little risk as possible? Again, especially in this environment, right? There's going to be a time to get aggressive. It's not when the stock market is trading at the second highest valuation it's been at in 50 years. Okay. And at the end of the longest bull market in history. So it's assessing how do we get there? How do we accomplish those goals? Looking outside the box, not just relying on bonds and stocks. Maybe we need a real estate investment trust mixed in there. Maybe we need some short-term treasuries paying. Maybe the answer is to have a zero risk portfolio right now for you. It really depends on where you're at, and then building a portfolio that represents that. And then the next part of it for us, and I tell people this all the time, what most firms do is they take your money and they put it in managed money programs. Okay. If we did that with our clients, I would be able to get rid of my 2 analysts, my other portfolio manager, and our 2 full-time traders. Okay. That would save me about $1.2 million a year. People ask me, well, why would you spend that extra $1.2 million a year? And I go, why do you think? Right? If I could, that's not a bad deal, right? If I do it like everybody else, I immediately make $1.2 million a year more. I'm not a crazy wealthy guy. 1.2 mil is still a lot of money, right?
It is, yeah.
Well, the reason we do it is because we took an oath to do what was best for our clients. And, sometimes it will work, but bottom line is we have an incredibly complex changing environment, and we need to be able to pivot at the drop of a hat with all this craziness. And, that's the way. I mean, I wish we didn't. I wish I believed that doing it their way was the best, because like I said, I would have a lot more money. But that's part of us being a fiduciary too. You know what I mean? Where we are truly on the same side as the client, meaning if your account goes down 40%, my paycheck does too. Right. And I think that cooks should eat their own cooking, and they should have skin in the game. And when you're set up like that, it really is a partnership, right? We're both eating the same cooking, and our tails are both on the line. And, we're going to protect their money like it's our own.
So how can people get in touch with you and learn more?
Yeah. So a couple easy ways. First of all, you can go to our website, bulwarkcapitalmanagement.com. You can find our weekly radio show at knowyourriskradio.com. We're on every podcast service out there, Apple, iTunes, all that stuff. You just search Know Your Risk Radio. We also do a daily thing called the Daily Dots. So every day after the market closes, we do a 12 to 15 minute summary of what important happened that day, important earnings announcements, Fed minutes, all that kind of stuff. Pretty easy to find. And then in the next week or two, we have a virtual roadshow coming up. It costs nothing. It's about a 45-minute presentation that shows you our process, shows you what we do differently and how it works and how we can lower risk, lower your fees, and increase your upside. And we're just showing you how it's worked, right? Not making prognostications, just showing, hey, the proof's in the pudding. Here's how we do things. And then if they're interested further after that, they can set up a call with me or one of our other advisors and really get an in-depth, and then we'll make a portfolio suggestion for them. And then there's no twisting arms, right? If you want to be a client, you want to join us, great. If you don't, hopefully you leave more informed. But the virtual roadshow coming up in the next week or two is probably the easiest way. It's free, only have 125 spots. They usually fill up pretty quick. But I think that's the easiest way to get a good, 360-degree understanding of what we do and how we do it.
That's awesome.
Awesome. Yes. Yeah. Thank you so much, Zach. You're always on top of everything, and you break things down so easily for people to understand it. We appreciate it.
Oh, thank you, ladies. Always fun to be here.
Thanks, Zach.
Bye.
You bet. Have a good one.
You too.